it's very important that investors setting up in the market familiarize themselves with the regulatory, tax, and compliance framework. It is therefore imperative that they get sound professional and legal advice in these areas. One of the key factors to consider when setting up and to understand is the legal framework. In Kenya, Tanzania, and Uganda, the corporate law is largely based on the English common law. In Burundi, Rwanda, and DRC, the corporate law largely borrows from the French and the Belgian law, whereas in Ethiopia, their corporate law borrows from the Italian law. The second key consideration is the business vehicle or the type of entity to be set up. There are various options, starting with companies. Companies could be private or public, limited by shares. And these generally are for commercial purposes. The second type is branches. Branches would be a branch of the parent company, and they don't have separate legal liabilities from the parent company. They're merely an extension of the parent company. These tend to be useful or appropriate for purposes of projects and easy to close up or wind up when they're at the end of the project. The other type of entity available are partnerships and limited liability partnerships. These are appropriate for professional firms like law firms and accountants. The other type of entity are trusts or limited trusts. We also have the option of companies limited by guarantee, which are ideal for companies that are not, or for activities that are not for profit. We also have the NGO dispensation, and these as well are ideal for companies not for profit. And finally, but not least, in terms of importance, are the sole proprietorships and business name registrations. All the above options are available across the three jurisdictions, Kenya, Tanzania, and Uganda. The other important consideration that investors ought to be aware of is that the registration requirements are similar across the three jurisdictions, Kenya, Tanzania, and Uganda. However, there are certain differences which are important for the investor to be aware of. In terms of directorship and shareholding, in Kenya, it's permissible to register a company with one director and one shareholder as a minimum. The director and/or shareholder need not be a Kenyan. In Tanzania and Uganda, the minimum requirement is 2 directors and 2 shareholders. On the matter of land ownership, in Kenya, foreigners are not allowed to own agricultural land. Whereas in Tanzania and Uganda, the restriction or prohibition extends to all types of land. For regulated companies operating in regulated industries, specifically financial institutions, mining sector, and the insurance sector, there may be a requirement for local shareholding, and this will depend on the type of industry. The other 2 key considerations are tax considerations. It's important that the optimal tax structure is decided on. For example, the effective tax rate, corporate tax rate for a branch is higher than that of a limited liability company, and that is across the 3 jurisdictions. Finally, in terms of time frame, it is important to understand that the time it takes to operationalize an entity varies across these 3 jurisdictions. For example, in Kenya, it would take 3 to 4 weeks, whereas in Tanzania, it would take slightly longer, and as is the case for Uganda.